Hey everybody, hey traders, Chris Paul here. Closing bell to around 5 p.m. on the 15th of August. Just want to do a little daily recap as well as talk about where we are for the week. A couple of interesting things. Had a couple of screenshots to share. This is essentially what the week is doing. This is some short-term trading that I put together workspace-wise. I have the weekly VWAP here in the dark blue and then a light blue as a daily. Monday was a little choppy to get things rocking and rolling. We knew that the big data was coming on Tuesday and Wednesday. And also, finalized the news on Thursday. So we had PPI news for the US that came in lower than expected, which is what the market wanted to see. We had CPI on Wednesday, which also came in lower than expected just by a little bit. We came in 2.9 versus 3% year over year. The market was a little iffy on Wednesday, but the trajectory was still up. The bears were absent all day outside of a little bit of noise. And then Thursday, just more of the same. We had unemployment claims come in a little bit lower, which the market liked. We also had retail sales and core retail sales come in better than expected, which the market loved. And this week, from a starting point here, this is E-mini futures around 53.60 up to 55.60. That's a 200-point swing on the week. If we go to the SPY, doesn't quite look the same because of our gaps from closing bell to opening bell, but Monday to Tuesday to Wednesday to Thursday, you can see that the market is trying to accomplish a bull recovery. Now, I say that because where are we at? If you checked out my video yesterday or recently, this high that we had back on August 1st, to me, is the important spot that the bulls are going to have to overtake in a big way. If there's any chance that this market is going to stall, I would imagine it's stalling here at that Thursday decline. We had FOMC, we had a Thursday decline that led to a Friday decline, which led to that big gap open on Monday, which was the bottom. And wouldn't you know it, the market has been just on a straight up rip for the last 2 weeks. But I just think this is a key technical level. Now, this doesn't mean that I'm bearish, but we do have a gap here to fill. And if those do retreat a little bit off those highs, I could see the market just taking a little bit of a breather. Because if we just blow through this level and we break and we pause above that Thursday high, then these all-time highs are legitimately in play for recovery. Now, one more thing on the chart. I know that I'm zoomed in on a 5-minute chart, but I can still go back to mid-July on this chart. I want to show you a little measured move here on an inverse pattern. This is an inverse cup and handle, which looks something like this. If we have no structure and the market rips up here, pulls back, and then breaks above, that is an inverse cup and handle, and that's a very powerful and common reversal sign for the stock market. And we actually have one. So when we had this gap right here, you can see that we had no left structure. The market rips all the way back up here for that Monday, Tuesday, Wednesday, forming this little swing. And here we go. So we have low to high, we pull back here, and this is the cup and handle level. And so what do? We'll come into this week's trading. We start right there, and then we gap open on Tuesday. And so Monday to Tuesday, this thing is off and running. Now check this out. Measured this move, and we are nearly at completion. So if I go from the low to the high, okay, we don't measure the move from this higher low. We measure the move based on this breakout. So once we have this move here, I'm going to go ahead and clone that box and put that on top. Let me delete my box here. There we go. So I'm just going to stack those on top of each other, and you can see that we are right at this measurement point on Thursday near closing bell, right before that Thursday drop we had on August 1st. Again, I'm not calling the top. I just think this is crazy interesting that this market just relentlessly recovered here the last couple of weeks. The VIX has been just smashed all the way back down into the pre-vol event levels. You know, we were sitting at 14, 15 on the VIX. We rallied up towards the 21, 22 handle, got up into the 23 to 28 handle, and then exploded higher to 30 plus and 60 plus, and then retreated. It has been a nonstop bear move on VIX. The term structure has flipped to now expecting higher volatility in the next 30 to 60 days. I'll show that in just a moment. But I did think it was interesting in the short term that this little cup and handle pattern has truly marked a V bottom recovery. And it wasn't a Fed intervention. You know, for the first time in a long time, it wasn't a Fed intervention. Now, take a look at the bigger time frames here. Where did we finish on the day? S&P up 1.7, Qs up 2.5, Dow up 1.5, Russell up 2.5, VIX down another 6%. Here is what I'm talking about with just that crazy extraction in implied volatility. I mean, the market went from The second highest, or actually third highest of all time. So we had 2008, 2020, and this were the three highest levels the VIX has ever reached, and the market just came right back down. Now, are we going to see 12 or 13 again on the VIX? If we do, I don't know how we don't have another vol event coming before the end of the year. Just saying, that gives me zero comfort thinking that we could return to these crazy low volatility levels. And this is just one massive volatility bubble that bursts and just punishes the market for a weekend. And then the market becomes like right back where we were, eyes on the prize, and we're just ripping another 2 weeks straight. So I'm watching the VIX. Where are we at in the SPY? Well, I think this Thursday level is what I'm going to be watching for. This is, Thursday, the 1st of August. If the market's going to settle in here, I could see, and I'm sorry that the charts look a little bit noisy, but I've been, measuring and looking at all sorts of things to kind of make some sense of what is this market trying to do? Because I looked at a V bottom off of this chart, right? So we have low to high, pull back. There's our V bottom. We break that cup and handle neckline, and there's your rip to the upside that got hit today. So today's gap and drift higher. I was fortunate to get a nice little short-term trade. I think, let me open up my chart here. I had a little play on the S&P today. I had a couple of profits actually, which I was kind of happy with. So in the near term today, once we had our gap up, so we had close yesterday, open today. I was staring at this large gamma level, which is at 555 on the SPY. And so when we opened today, I actually bought a 555 long call. And my expiration was a 1 DTE. So it wasn't a zero. I went out to actually Friday. And because this market from opening up around 550, rallying up towards 553, that $3 move allowed me to make a 46-cent debit that I closed out for 96 cents profit. So pretty good gain on that. Just over 100% return on capital, which I'm obviously happy with for a short-term trade. And I didn't have to wait all the way till tomorrow. I also took a one-day vol trade. It was a 550 by 560, and on the put side, I did a 535 by 525. Closed it out for about 21% return on capital today. So the market's been good. The recovery's been great. I did see this level here right around 555, which is right back to the same level I just talked about. This is a key level. Now, seasonality wise, let me show you a couple things. Unemployment rate. Okay, we saw this during non-farm for that print in early August. This was August 2nd. We printed at 4.3. That's what activated the SOM rule. If we go to, let's go non-farm payroll here. This is a big miss at the same time. So that August 2nd print was a terrible whiff for the U.S. job market. And 114, we were way below expectations. Expected moves 176 came in 114. If we go to the unemployment claims, this, on the other hand, has been giving the market some positive traction because it's not really a derailer of what we've seen the last couple of weeks with the momentum since we bottomed out on Monday. We have seen jobless claims every week moving down a little bit. So that just means that, okay, maybe the August 2nd non-farm print was a little bit of a miscalculation. I was reading after the fact that, it may be because of weather. There might be, okay, fine. Well, we'll find out when we have non-farm payroll coming up in a few weeks. So a couple of news things I want to make mention about. We came into this week. We had the PPI data on Tuesday came in softer than expected. That was good for the market. We have Wednesday. CPI data came in slightly better than expected. Here is also the inflation data. So if I go to inflation data, year-over-year CPI, we printed, there it is at 2.9. Again, pretty sticky. I mentioned this in a previous video. For the last year, we have really not seen incredible improvements in inflation as far as year-over-year. However, since March of this year, we have been trending lower. And perhaps that's also what the market is running with. We've had enough of a slowdown, enough of an uptick in softer employment that inflation data is coming down. But I was almost, it doesn't matter. The market's up all week. It's ridiculous. But my point was I was looking to see that I thought the 3% forecast for this week year over year was almost intentionally high. We were going to come in, 2.8, 2.7 and have a big improvement in inflation, and that was just going to give the market more ammunition to rip. The market didn't need it. It was ripping all by itself. So that's where I'm just comparing a couple things fundamentally and where are we at here. So as we go into seasonality, just one more thing on this chart. Seasonality month. Let's go here on the S&P. I think this is important to know that we are about to come out of the summer trading where the market, for the most part, doesn't perform super well in September and October. And so even though we had, think about this, we had a tip in July, okay, that rolled down about 10% in the S&P, okay, just shy of 10%, and we have came roaring back all the way to this level, which is around 7 or 8% to the upside. If you have a 10% decline, you're going to require 11 plus percent to the upside to get back to break even. On the NASDAQ side, you had a 20% decline, so you're going to have like a 30 to 35% recovery to get that back, right? So we're not out of the woods yet, but I do think this is a critical spot to make sure the market is fully capable of saying, hey, look, these bears are for real. These bears are going to continue to grind. I would still say the brakes are likely going to be put on by the all-time highs again. Doesn't mean that they can't stop, but I do wonder if I just see through my charts for a second, are we having the market do something like this? We have made an incredible recovery in a short amount of time. I acknowledge that. Now, from this high to this low, about 9.7%, give or take a couple of tenths, right? So, are we going to see this rip here pause and try to justify that this market can in fact go higher? Or is this market going to not give a funyun about anything other than trying to go higher, 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 get to these all-time highs? I would be so worried about another volatility event if we get through these highs and just do it with that one off move. So I'd almost like to see a little bit of a reality where we have a high, we have a low, the market somehow stalls, rebalances just for a little bit, just for a little bit. And is this a bullish pattern? Sure. This could be a great bullish pattern. Maybe we have a little bit of uptick in volatility, but if price doesn't fall, then we could be looking at this as a corrective move. Okay, and we settle back in here, then we have a head and shoulders. If we break above this, we could justify all-time highs. But I'd like to see some accumulation, right? This is heavy amounts of recovery, heavy amounts of manipulation. If we're going to see some accumulation, my gosh, I'd like to see it on a pullback. I'd like to see it here on a dip or a gap fill or something. So that's what I'm hoping for. I mean, I just didn't get as aggressive as I suppose I needed to be for this type of recovery. One thing that was really interesting, I was talking about this today in a live session. If you look at the VIX dropping the way that it did, a couple easy instruments to trade. I did get in on SVXY. I bought the shares at 40, which was a pretty good grab there, and I also have some puts that are doing pretty well. If I take any ownership of SVXY with any of my sell puts, that would put me around a $49 or $48 break even. And if we continue to see this SVXY and the VIX continue to drop, I will be looking to take some profits if we get back up into these highs. I would like to see some profit here. So from 40 to 60, flip this thing for about $20 a share, which is pretty solid. You probably take zero assignment on this. And then a friend of mine did the same thing on SVXY or SVIX, where he bought this thing around 23 and he's currently up around 31. If this thing gets back to the highs, same type of thing, buy it at 23 and get back out here around 50. I mean, another just crazy upside move of around 100%, which is obviously a much bigger recovery than what you'd see on the NASDAQ or on the S&P. All right, let's go back to the Qs for a moment. We're talking about this, Thursday gap. Let's see what this was to the downside. We're just shy of 20%. That is almost 16% to the downside, which means we have to have, and when I said 20%, I was referring to the NASDAQ futures. The NQ was down just shy of 20%, but that was a long wick on Sunday to Monday's open. So that's why the Qs only open up here. But still, here we are going to the upside. If we're going to get back to those highs, we'd have to have almost a 19% recovery on the NASDAQ, which again, if you think about that, this market just dumped 15, almost 16%. And if we get back to these highs, and we do this in a cycle of, let's say, 30 days, if we go from July to August, okay, or middle of July to end of August in a month and a half, and we have a 15% decline for an 18 to 19% rally, that is pretty darn volatile, if you ask me. So again, I'm looking at what this thing is doing here. If this is a low to high, if there's a little bit of a stall here, I could see this building up as a pattern. A little bit of hesitation, I think, would be good as we head into what is seasonally a bad time in the market. Okay, now this doesn't mean like crazy bearish. It just means not good, right? I mean, the 10-year average in September is down 1%. The 5-year average recently, seasonality wise, we've had a pretty rough 5-year stint. In September, down nearly 2%. And even October typically starts on a rough foot and then finds a way to work itself back towards the end of the month as we rip into November, December for that holiday rally. So I would expect, just from sheer seasonality, that September, October is going to put a little bit of a stall on this rip that we are seeing. Okay. So does that rip mean that we're going to stall at the all-time highs, or does that mean we're going to stall here at this first level where the market started its descent on Thursday, the 1st of August? So that is, to me, that's the $100,000 question to many of you, or the institutions of the world. That's the $1 trillion+ question. We don't know, but I will say that I did add a bunch of defense, and I'm kind of mad at myself for doing that because I did a bunch of 0.25% hedges that took about 1 to 1.5% of my account. That might end up being worthless for the next 30 to 60 days. Um, at the same time, rather than complaining about it, I will say that it's necessary to have some hedges. It's necessary to have some protection just in case. But at the same time, I'm trying to also, trade what I see, which is bullish. I'm actively in the SPY, in the SPX, in the Nasdaq, and I'm trying to grab some profits day in, day out if I can. And so far, it's worked out pretty well. I've had some daily profits this entire week. Win, 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 win. Some short-term gains on some long calls. That's been great. That's been pretty easy. Some vol plays. So from an active standpoint, no complaints. But from the overall bigger picture, all I got to say is wow, right? I mean, what a crazy rip this has been. So, what do we have lined up next? News wise, I think this is important. I talked about this a lot in my live sessions today. What is important moving forward? So, tomorrow is going to be fairly quiet with just consumer sentiment on Friday for the US. We go into next week. It's pretty quiet on the US front, but we do have PMI data coming out on Thursday. We have FOMC meeting minutes on Wednesday afternoon, just minutes. So, will it point to anything, hint to anything for September's rate decision? We'll find out. The numbers have also been changing quite a bit probability wise for the Fed to likely cut rates in September. But now the whole idea of an emergency rate cut is kind of off the table. Now it's looking for the pretty much, the depicted, or I'd say the scripted 25 basis points cut that the market was expecting all year once we kind of push through summer. So we do have PMI data on Thursday. I would still like to see for the U.S. that services and manufacturing PMI prints above 50. That's another good sign for good news is good news and bad news is bad news. If we have PMI numbers coming in above 50, that's a good thing for the U.S. economy. We also start on Thursday and Friday Jackson Hole. Jackson Hole, maybe I just had bad dreams about this, but it was a very volatile event last year because we had NVIDIA earnings the same time we had Jackson Hole. And it was an incredible 2 to 3 days of volatility. This time, we just have Jackson Hole on Thursday, Friday, and NVIDIA earnings are the following week on the 28th after market. And then on Thursday, we have unemployment claims, GDP for the quarter, and we also have PCE on Friday. So August, even though this has been a great couple of weeks, August is not done yet. So I would be super, super surprised if the market is able to get through these all-time highs with no pullback. That's all I'm saying. Now, that doesn't mean that I'm looking to trade the pullback. It just means that I'm watching to see if we have a chance to buy a dip. For crying out loud, if we're going to get to these highs again, which I kind of hope that we do, I'd like to see an up move, a down move, and something to kind of level back into, get some more option trades, credit spreads, and something to generate some income and see if we can get back to these highs by the end of the year. Because I'm still going off of some historical significance, which is first half of the year is greater than 10%. There's a high probability that the second half of the year still finishes positive. And so for us to have this, Qs are up 20+%, S&P up 15, 18%. If we just get back around those levels, that's going to be positive for the second half of the year, as opposed to everything that happened, late July into early August was this huge dump. And now we're struggling to get back to any type of traction, right? So it's like first half would be great, second half would be garbage. And then you finish the year and it's like, well, we're kind of flat, which maybe that happens. But my point is, we've had a tremendous recovery. I'd like to see a bit of a pullback if we can get it. Maybe looking at some levels here that make some sense to be a buyer. If we pull back any deeper, maybe have some type of vol event. If this market is not done yet, maybe, just maybe, but man, we'd have to have another doom and gloom type of outlook, and we have to have some really soft jobs numbers coming out. We'd have to have some really soft news events printing for the U.S. And at this point, I feel like that's not happening. Obviously, a lot can change, but that's what I'm watching. So there's a lot to digest, and I know that's silly because it's August. Go out, enjoy your vacation, enjoy the rest of your summer. Hopefully, you're not starting school yet for you or your family or kids. But man, this is probably been way more exciting than I want it to be, and not necessarily in a good way. It's just a little crazy. But you know what? The markets get crazy. We have a bit of a temper tantrum being thrown here, and it's just, I mean, I keep saying it, like, it is what it is. I'm going to do my best, as I always do. I'm just trying to make some sense of things. And so the first thing I thought was we do have a pretty nice cup and handle that's hitting symmetry right here. And then if we go back into this as a larger swing, so we'd have this left low to center low. If we're going to call this a near term top, then there's another swing to the upside. I could see the same level, left structure, right structure, which to me on the SPY and the SPX has to stay above 530, or on the SPX around 5,300. If we stay above those levels, I think that is a pretty good point to support this trend line and stay in the safe zone for this market to try to get back to all-time highs. But I'll keep going back to this and I'll wrap up the video. Seasonality wise, I don't expect crazy bullishness to happen through the rest of this month or into September, October. The market, seasonality wise, will probably take a little bit of a breather. And if it does, that's based on a 5-year average. That's based on a 10-year average. It's called the September effect for a reason. It's usually one of the most bearish times in the market. You look at this, this edge finder tool here for 10 and 5, all the way back here. There's not a single down month except for September and then October, right? So we survived for a little bit of decline here in July and August, but I don't think that we have just rip roaring gains to the upside. And that's kind of my outlook for right now. So I hope that helps make some sense of things. Couple things to measure. We hit this move here. What a ridiculous week from Monday, Tuesday, Wednesday, Thursday. I'm curious to see what Friday gives us. Maybe a little bit of nothing. If there's any type of profit taking this week, we could probably pull back and see some gaps, which I obviously wouldn't mind seeing just to see this market have a bit of a reality check. Because again, I go back to this chart here. This has been crazy. Okay, look at this. This type of price action is crazy. Okay, Tuesday. This would be Wednesday, Thursday. So Tuesday we had, I want to say Monday, Tuesday's in here somewhere, but this is your Tuesday to Wednesday gap. So here's Wednesday's open. We rip on Wednesday. Here's your Tuesday open. We rip on Tuesday. Here's your Wednesday to Thursday open. We rip on Thursday. So Tuesday to Wednesday to Thursday. I mean, we're covering a lot of ground here, everybody. This is supposed to be an index that moves about 15 points a week. And we started out here around 520 or maybe 530, and we're up to 553. We have gone well beyond the average move. And I can show you that here on this chart, but just crazy, crazy stuff. So maybe I shouldn't be so surprised, right? I should just soak it in like, yeah, it's whatever. It's just what the market does. Well, it's not what the market's forecasting, right? Here we are with the Qs. Let me go back to the SPY. The SPY ATR for the last 14 trading days is a $14 average trading range on the week. And what have we gone this week? I'll show you. And then I'll let you go. I appreciate your time being here. Look at this ridiculous rip we've seen for 2 weeks. This is crazy. I keep saying it, but it's true. Look at this thing. This was last week, the low at 510, the high at 534, a $24 recovery. The low this week at 530, the high at 553, a $23 recovery. Holy shnikes, right? Even from April, just a little pullback here, and then the Mag 7 saves us. This time it's like vol event, buy on the dip, you get what you want, 10%, and this market just frickin' rips. Impressive stuff. So, all right, stay tuned for more. Happy trading, lots of profits. See you soon. Thanks.